Hook and promise. Hey everyone, welcome back to the Capital Breakdown. Here's a question. Can spending just 20 minutes a year on one simple habit really make a big difference in your investment journey? Sounds almost too easy, right? Today, we're diving into rebalancing, an underrated but powerful practice serious investors use to keep their portfolios on track. By the end of this episode, you'll understand what rebalancing is, why it matters for managing risk, and how it can help you stick to your financial plan through the ups and downs. No complicated jargon, no hype, just practical insight to help you take control of your money with confidence. The problem or confusion. Most people don't think much about rebalancing or even know what it means. Imagine you have a basket with apples and oranges representing your investments, stocks and bonds, for example. Over time, apples might multiply like crazy while oranges stay the same. Suddenly, your basket is mostly apples, even if you wanted a mix. Many investors either ignore this or get confused, letting their portfolio get unbalanced without realizing it. It's like going on a road trip and ignoring the GPS, hoping you'll end up at the right place without checking directions. Without rebalancing, your portfolio's risk and goals can drift, sometimes without you noticing until it's too late. Okay, core concept explained. So what is rebalancing? At its core, rebalancing means adjusting your investments to maintain your desired mix, your target allocation. Picture your portfolio as a set of buckets filled with water, stocks in one bucket, bonds in another. Over time, one bucket might overflow while the other shrinks. Rebalancing is the act of pouring water back to the smaller bucket, keeping each at the right level. This keeps your risk in check and your plan on course. It's not about chasing returns, but about sticking to a disciplined process. Key terms here: target allocation, your ideal investment mix; drift, how your actual mix changes over time; and rebalancing, correcting that drift. The core concept explained, continued. Think of it like tuning a guitar. If your strings go out of tune, the music sounds off. But with a little adjustment, the harmony returns. Rebalancing tunes your portfolio so that it stays aligned with your risk tolerance and goals. It doesn't mean selling winners because you're greedy or buying losers because you're hopeful. It's about steady stewardship. This habit can help smooth out the bumps in the market by preventing one part of your portfolio from getting too big or too small. In other words, it helps keep your investment journey steady and intentional instead of reactive and risky. How it actually works: behind the scenes, rebalancing happens in your brokerage or investment account. You might decide to do it yourself or use automated tools many fund providers and robo-advisors offer. When you rebalance, you're essentially selling some assets that have grown beyond your target and buying those that have lagged. This process can involve transaction fees, taxes, or bid-ask spreads depending on your account type and investment choices. Regulators don't directly control rebalancing, but they ensure markets are fair and transparent. The key players here are you, your broker or fund provider, and the market itself. Money flows between different assets to restore your desired balance, helping manage risk and align with your plan. How it actually works. Continued. It's important to know rebalancing isn't free or automatic unless you set it up that way. Some investors rebalance annually, quarterly, or when their portfolio drifts by a certain percentage. This can mean a quick 20-minute checkup once or twice a year, not a full-time job. Also, keep in mind that frequent trading might increase costs or tax bills, especially in taxable accounts. That's why many investors lean on broad, low-cost funds, which make rebalancing simpler and cheaper. The goal is to keep your portfolio's risk consistent with your plan, not to time the market or chase performance. Simple, concrete examples. Let's say Jane invests $500 every month into a broad index fund that tracks a large group of companies. Over time, that fund grows, but maybe her bonds don't keep pace. Without rebalancing, her portfolio becomes mostly stocks, which might be riskier than she wants. Once a year, Jane spends 20 minutes reviewing her investments and sells some stocks to buy more bonds, bringing her allocation back to her original plan. This helps her avoid being overexposed to stocks just because they did well recently. Now, imagine Mike, who bought a single speculative stock that doubled in value. Suddenly, that one stock is half his portfolio, a risky position if the stock falls. Rebalancing would mean selling some of that stock and buying other investments to maintain balance. Emotionally, this can be tough because it means taking profits off a winner, but it's a key risk control step. Simple, concrete examples continued. Both Jane and Mike's scenarios show how rebalancing isn't about chasing hot picks or jumping on trends. It's about maintaining a steady course amid market noise. For Jane, it's a routine check-in that keeps her risk level where she's comfortable. For Mike, it's a reminder to avoid putting too many eggs in one basket. Neither approach guarantees gains or protects from losses, but both encourage discipline and reduce emotional decision-making. That's why serious investors treat rebalancing as a habit, a small time investment with potential long-term benefits. Risks, traps, and common mistakes. Rebalancing isn't risk-free or a magic bullet. One common trap is ignoring risk altogether by letting portfolios drift into risky territory without rebalancing. Another is overdoing it. Rebalancing too often can rack up fees and taxes, which eat into returns. Concentrating too much in single stocks or sectors can also increase volatility, making rebalancing more urgent but harder to execute without losses. Leverage, options, or margin add complexity and risks that rebalancing alone can't fix. Finally, impatience can be costly. Markets wobble, but staying consistent with your plan, including rebalancing, helps smooth that ride. Remember, no strategy removes risk. It's about managing it thoughtfully. Risks, traps, and common mistakes continued. It's also important to recognize that rebalancing decisions depend on your time horizon and goals. Younger investors might tolerate more stock exposure and rebalance less frequently, while those nearing retirement may want tighter control over risk. Emotional investing can cause people to skip rebalancing when markets fall, out of fear or hope for a rebound. However, this can lead to unintended risk buildup. That's why having a clear process and sticking to it is essential. The Capital Breakdown always encourages a realistic mindset. Investing is a marathon, not a sprint, and steady habits often win over time. How to think about this tool? Think about rebalancing as part of your overall financial health toolkit, like budgeting, building an emergency fund, or setting clear goals. It's not a standalone fix, but a way to keep your investment journey aligned with your broader financial plan. When you budget, you decide how much to save. When you invest, rebalancing helps you keep your savings working the way you intended. It's about discipline and control, not getting rich quick. If you're saving for retirement, a house, or any goal, rebalancing can help manage risk so you stay on track even when markets wobble. It's a habit that supports long-term thinking and consistency. How to think about this tool continued. Remember, rebalancing isn't about reacting to every market headline or trying to time your moves. It's about having a clear plan and following it with confidence. When combined with other good financial habits, like saving regularly, diversifying your portfolio, and knowing your risk tolerance, rebalancing becomes a steady guidepost. It helps you avoid emotional decisions that often lead investors astray. Keep it simple, be consistent, and think of rebalancing as a tune-up that keeps your financial engine running smoothly over the years. Recap and educational disclaimer. All right, let's wrap it up. Today we learned that rebalancing is a simple but powerful habit, adjusting your portfolio to keep your risk and goals in check. It helps prevent drift, manages risk, and keeps your plan on track through market ups and downs. We also covered the importance of discipline, understanding costs and risks, and how rebalancing fits into your bigger financial picture. Remember, this is educational content, not personalized financial advice. Always do your own research and consider talking to a qualified professional before making investment decisions. Thanks for tuning in to the Capital Breakdown. Keep learning, stay disciplined, and we'll catch you in the next episode. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.